Hey everybody, Greg Barron here, Professor of Real Estate. I'm going to talk to you today about something that so many people don't calculate correctly or they tend to leave off, and that's construction loan during a development process. Now, this will only apply if you're doing a value add to an existing facility that you're acquiring or if you're starting from scratch. But it's important that you understand the basics and you also include it within your capital stack evaluation. So today, and once again, I'm going to use ProformaPlus because it's much easier to teach and show you how it affects your total valuation and your financial modeling that you're doing for your project. So I'm going to jump into ProformaPlus, and from here I'm going to use both the project center and I'll use the capital stack. I'll turn it off and on to show you how it works. And then I'm going to jump into a report that shows you how typically there's a bell curve involved as a percentage of completion that you need to figure every time you're figuring your interest carry for a construction loan. One thing I do want to explain, however, is that normally if you're dealing with something that has to be stabilized, that means a facility that you have to lease up, a multifamily, a multi-tenant office, a multi-tenant medical building. You normally do not release from your construction loan until you're at X percentage of stabilization. Now that might be 80, that might be 90%, but most bank covenants require you to be at a certain level of stabilization before they move from a construction loan to a long-term permanent loan. So let's hop into ProformaPlus because again, that's the easiest teaching tool. And don't worry about the numbers at this point in time. Don't really anchor into the interest rates or the term. I think foundationally, once I go through it, you'll understand the reasoning behind how you enter the rates, and then you enter the percent of complete that will ultimately give you the total interest carry that you'll need to move from your construction loan to your long-term permanent mortgage. So as we look at this particular project, it's got a principal borrow of $5.7 million. I've included a rate of a whopping 8% on the construction loan, and it's a 65% loan to cost. And then I've got some miscellaneous closing fees, some periodic draw fees that your bank covenant might require. That's where they go out and inspect. And typically during a construction loan, it's not unusual for a bank or a lender to require a third-party inspector to look at your application for payment or your contractors and then compare it against what's actually in place. They'll approve it. They'll send an invoice to the bank will send it on to you. That's fairly typical unless you've had a long-term relationship. So we know that we've got the rate, the term. Typically the term is set up beforehand, and as I pop into the capital stack, you'll notice under the senior debt on this one, and we're going to call it senior debt at this point because construction always migrates into a permanent loan. On this particular system, we have the opportunity to either include it, or by checking this, we exclude it if it's a pure acquisition. But for this one, it's a ground up development. So I've already given it in my initial data entry, I've already told it when we close, and then I'm going to designate that this particular term is going to be 12 months for construction. And then my anticipated refinance date that I've tied to my absorption, or when it goes from construction to permanent, I've given it a date prior to this as well. So then in the way that this figures it, which is a really cool feature, we've set it up so that you could give it a distribution bell curve according to what percentage you're going to draw every month. Now, if you're doing a ground up building, after doing close to $1 billion worth of construction and development myself, I can tell you that it usually goes in a bell curve like this, and I'll show you a report in just a second that will drive that information home. But this sets it up for monthly draws, and here you can see we've got 12 months. And starting with month 1, we've got a lot of our fees and other things at 6%. Then it goes to 8% in month 2, and then it goes to 11% in month 3. And again, this is merely prediction at this time. You'll want to get with your contractor, whoever's building it, to give you an estimation of what they anticipate to draw every month so that you can estimate what your construction interest carry would be, because every month you're going to be charged interest upon interest upon interest, and it's going to accumulate. But as we get down to the very end, the summation of all these percentages equals 100%. And you'll see that we have a draw amount, and then we have points and fees that might be applied, and then the interest, and every time that interest is carried over to accumulated draws till ultimately your loan balance increases as you're drawing down on your construction loan. So as we go to my report, I'm going to go down to the construction loan analysis to show you a graphical interpretation of just what this means. So you'll see here that it's real easy with this system, and there are other Excel spreadsheets that do a simpler calculation. This one does it to a T, I could add. But here you'll see that sure enough, it's a form of a bell curve until ultimately you've exhausted all of your construction loan amount, and it also calculates your ending total amount of interest and fees on this particular job. At the end of 12 months, I have right at $295,000 of total interest and fees. Yours might be a lot less, it might be a lot more. But the main impetus of this whole teaching module is to show you that you need a system for construction draws to be able to calculate interest carry upon interest carry until you've totally exhausted your construction loan. Thanks for joining. We'll see you soon.